calling government to account, where there's been breaches and where there's been fraud and irregular expenditure and so on. And they were very vocal when it comes to holding government to account, and rightfully so, rightfully so. But when I raised the issue of Steinhoff on this particular business when it comes to holding, everybody went quiet, and rightfully so, rightfully so. And when I raised the issue of Steinhoff, I realized on this particular business when it comes to perhaps in the private sector, there needs to be proper legislation which prevents the public from being harmed through what your delinquent directors, even within the private sector, do. So, having said that, I think it's going to be a fine balance between ensuring, and the challenge of unemployment, I do not think it's business's fault. Unemployment and the challenges of inequality is not necessarily just the private sector's fault. And I think more so, I think government needs to look a little bit closely at some of the structural changes that need to take place within government in order to address the challenges of inequality in South Africa. And so I'm couching my words very carefully, because while to some extent I would agree that we need to look at legislation which prevents excess at a business level, but at the same time, what we do not want to do is to discourage and put disincentives for some key individuals to keep businesses going in the country. So yes, I think also looking forward to further debate and discussions on the two bills. Thank you. Thank you, Chair.
Thank you very much, Honorable Tring. Honorable Chris Malemecha.
Thank you, Chair. Morning, colleagues. Let me take this opportunity to welcome the presentation. Very straightforward. I think it helps to deal with a number of some ill social challenges, including the high employment rate. One way or another, if people can have a way of being able to come up with their own initiatives that can assist without some barriers. I think we are moving towards the right direction. It's a matter of us coming together and acknowledge that all these challenges are not for individuals or for certain people, for all of us. And we reduce politics when we deal with them, because high unemployment rate is for South Africa. It's not for certain race somewhere. It's for all of us. And all of us, we must contribute with our initiatives that we think can assist. The minister and your team here, and whoever was part here, I think this presentation is very clear and is doing it best. And dealing with the damage that was caused by those who were benefiting when others were suffering. You will understand it's not going to be an easy thing. Minister, it is just this question need to be asked. How will the reasonableness of the remuneration be determined or assessed in terms of the Act? Then the second one, what remedies does the Act provide under circumstances where there is no correlation between the reasonableness of the remuneration of the senior executives and the lowest paid employees? When you go further, Minister, slide 19, the information note indicates that the public companies will need to submit remuneration report to be approved by the board as per section 8A, if you check there. What will be the effect on a private companies? I think we are in one country where we'll have the public and the private companies. Now, that the latter speaker was attempting to come there. I said, let me come direct that way. Minister, like slide 15 on the disclosure of beneficial interest governed by the Amendment 26, there's an indication that some companies will be excluded. Which type of companies are these, and what is the reason for their exclusion? Thank you so much, Comrade Chair.
Thank you, Honorable Malemecha. Honorable Monakedi.
Chair, thank you very much. I also want to add my words to those who have welcomed the presentation by the Minister. I think it's indeed quite tenuous, and it dovetails nicely with what already has been the measures the Minister has taken to make sure that we respond accordingly to the challenges of grey listing. My first question for clarity is with regard to slide 18. In terms of amendments rather to section 30A, there is a new statutory requirement for public companies and state-owned companies to produce the remuneration policy for directors and prescribed officers for approval. What consequences does the Act or the bill put in place for failure to obtain required approvals? My next question, Chair, is inasmuch as the Act aims to address issues of income gaps and inequality, how will the reporting of this income gap assist in reducing inequality? How will it redirect or direct private companies to address the huge pay gap? This question is pertinent given the fact that South Africa is reported to be the most unequal society. So if one can get some clarities, some responses to those. Thank you very much.
Thank you very much, Honorable Manakedi. Minister, let me just check. I have some few clarity-seeking questions as well. I wanted to check, do the state-owned companies prepare their own remuneration policy, or they are prepared by National Treasury? Secondly, what will be the consequences for companies that do not disclose their remuneration policy? How will the reasonableness of remuneration be determined or assessed in terms of the Act? Then the last one, what remedies does the Act provide under circumstances when there's no correlation between reasonableness of remuneration of senior executives and the lowest paid employees? Thank you very much. Over to you, Minister and the team.
Well, first, thank you very much, Chairperson, and also to each of the members who've asked questions. I think the questions that honourable members have asked are questions that cut to the heart of some of the issues we've been deliberating on, thinking through, trying to find the appropriate balance. So if I start with Honourable McPherson's remarks and comments. First, thank you for the comments, Honourable McPherson. I think that the matter of ease of doing business is one of the things that we want to advance. And obviously, in a package of measures as the bill represents, there will be a number of areas where self-evidently it will make the ease of doing business, it will improve it. In other areas where there's a necessary public objective, we hope that the bill has been crafted in such a way that it removes any unnecessary administrative or red tape requirements, that it keeps it focused only on the specific objectives, and that it does so efficiently. And I hope when Parliament looks at it, it would be able to make that judgment on the matter. Yeah. So on the broader question that Honourable Macpherson asked, which is, does the bill make it more onerous and cost companies more? I think the bill does require some new provisions. They in areas of disclosure of the true owner of a company, and they are in the area of the remuneration, and those, without any question, are new. Now, on the question of the true ownership, the bulk of that has already been incorporated in the Companies Act. These are very small tweaks and refinements to what has been approved through the General Laws Amendment Act. I think Honourable Macpherson asks very interesting questions on the matter of the equity issues in the bill. And they picked up by Honourable Mulder, Honourable Tring, Honourable Malimecha, and Honourable Monakedi. So I'm going to try to deal with all of them, and I hope I do justice to each of the questions that have been asked. So Honourable Macpherson's first question is, what has been the response of business? And in the NEDLAC process, because the whole discussion around pay equity and disclosure became a significant conversation between parties in NEDLAC, I was quite struck by the high level of convergence of thinking between the business representatives in NEDLAC and the Labour representatives on a number of areas. On the substance, I would say there was considerable convergence of thinking. There were areas where the Labour movement wanted to go further than what is in the bill, or the business community wanted a more constrained approach than in the bill. But broadly speaking, it was striking the degree of consensus on the basic thrust of what is in the bill, with these particular and specific reservations. Honourable Macpherson then raises the question around the impact on businesses potentially having an incentive to hide remuneration, to not acquire high-performing talent, whether we're making rewards, whether we're giving it a pejorative tone by it being made to seem evil, and whether we incentivize employment outside South Africa. And Honourable Mulder picked up on the adverse effect on skills in particular, and on enterprise more generally. So let me deal with those matters by a broader framing of the problem before coming to the specifics. And the broader framing is, what are the options in society when there is significant public concern about the matter? We could take the view that this is not an appropriate matter for legislation and leave it be, and seek to have it addressed in other ways by other players in society, maybe shareholders in the decisions they make about boards. There are countries that have not done anything about it in their legal framework. But when it becomes as pressing an issue and the level of public outrage is as high as it is, then the public rightly expect that Parliament and the executive would take some appropriate steps. The question then is, what are those steps? And there's a range of steps that can be taken in the statutory treatment of income gaps in a company. So at one end of the spectrum, one can require disclosure. And that is make the information available and avoid lack of transparency on it. Moving further on the spectrum, the legislature may decide it wants to guide companies and say the guidance is that you should not have a gap above this ratio. Going even further, a parliament could, at least in theory, decide to prescribe, to say, thou shalt not. Now, I've given those three as examples of the kind of interventions that are possible. We felt that trying to prescribe the ratio between earners in a company is inappropriate, that markets are dynamic, that each company's skills mix may be very different. The requirements of specialist skills could vary between companies. And when the executive or the legislature seeks to impose a rigid arrangement on companies, it could have a number of very adverse consequences in the market, some of which members of parliament have pointed to. We gave some thought to whether there should be broad guidance, a normative standard, which, whilst not prescriptive, could assist companies. And it was felt that, having reflected on it, that it's not appropriate to do that. While it would not be prescriptive on companies, by the first challenge one would have is trying to identify what is that norm. And that itself would be quite significant an exercise, because it will vary greatly between, let's say, a high-risk small startup business where an entrepreneur is also the only person with a particular skill set and knowledge, from a typical standard mass production enterprise. It will vary between one sector of the economy and the other sector of the economy. And if one tried to do a single guideline like that, it's unlikely to offer enough guidance to boards and others to be meaningful, because of these wide range of factors that vary across the economy. And so we decided on what is the softest of the measures, but nonetheless particularly helpful. And that is to require companies to disclose and to require shareholders to approve. And that's where the discussion has been. It's a disclosure that then empowers shareholders to say, well, now we've got full knowledge about the remuneration policy of the company and how it plays itself out on things like differentials. We can now exercise our power as shareholders. So that's the approach we've taken. It was not without its debates. There was a strong argument made, and organized labor favored this, that the threshold should be 75%. In other words, for a remuneration policy to be approved, it requires the support of a supermajority of shareholders, 75%. So even if 25% of shareholders are unhappy with it, then the remuneration policy should not proceed. And the 75% and 25% are not just arbitrary numbers. There are some jurisdictions, there are places in the world where, in fact, there is a supermajority that is applicable. But having regard to the fact that this is a significant innovation to provide the kind of information that's required, we felt that an appropriate balance would be to leave it to a simple majority, to say 50% plus one of shareholders need to approve a remuneration policy. The fact that that remuneration policy comes up at an AGM we hope will act as an important discipline for a board, that it needs to look at many factors, skills needs, pay differentials elsewhere in the same sector, global markets, because South Africa operates in a global market in a number of particular instances where businesses and talent pools are exposed to global markets. But that they will also take into account societal concerns, and they will find a fair way of balancing these various matters, because they know that there will be scrutiny by shareholders when the report is tabled at an annual general meeting. That for us was an important step forward, and so we settled on that. So I raise that, Honorable Macpherson, because in a way, if one thinks of these three things, disclosure with shareholder power versus guidelines that are developed by the state versus prescription in law, we've taken the one that we believe will have a positive effect on the discussion on pay differentials, without tilting the balance to the point where there's an enormous cost associated with the gain. So coming then to the specific question, will disclosure result in businesses potentially hiding remuneration or finding ways of remunerating that is not your box standard? Now, generally speaking, the guidance in South Africa around remuneration is fairly strong and robust. So if a company director was to get free use of a company jet, as an example, or holiday home, then that has to be disclosed. So the law has anticipated already the potential for hiding of remuneration, and it has tried to address that. Of course, even with the current law, arguably there are ways in which companies hide these things. It is possible, but that's the job of an auditor, and that's why it's so important to have independent auditors, because they can ask the probing questions around the flow of money, but also the utilization of assets. And so while these challenges already arise from our current arrangement and will certainly be something that one needs to take into account, we do believe that the solution to that lies in effective audits and very importantly, proper standards. And globally, I think the accounting profession has developed standards to ensure that remuneration, in whatever form, shape, cash, kind, is appropriately disclosed. Now, Honorable Macpherson raises a second point, which is also quite an important one, which is, will the publication of the gap or of the level of remuneration disincentivize the acquisition of high performance talent? And it's important for us that as Parliament thinks through this, that Parliament considers that question. Have we secured a formulation that finds an appropriate balance between the different considerations? Where a company has high-performing talent, the bill does not in any way prescribe what should be the pay that goes with that talent. But it does place an onus on a company board to explain to shareholders why, in fact, the CEO or the COO or the IT specialist, chief IT officer is earning what they are earning. And so it provides a necessary discipline that if earnings are higher than one would normally expect, that there is an explanation, a rationale, that these are decisions that are taken based on rational decision making and a weighing of the evidence before a board. And that is what a shareholder is entitled to then in an AGM, to ask those questions. And when the replies are not acceptable to shareholders, shareholders then have the power to decline the remuneration report. So this does not constrain and put a cap on payments to a high-performing talent, but it does, we hope, bring in a more rational basis for ensuring that pay is for high-performance talent, as opposed to a clubby atmosphere in a board that results in payments that shareholders would not want to approve. The next area is on whether the publication of pay differentials will make the incentives for talented individuals seem as if it's evil. That was the phrase, I think, that Honorable McPherson raised. And I want to suggest, similar to my response to the previous part of the question, boards of companies now have an opportunity and in a way an implicit obligation, in a way an implicit obligation to rationally engage. If someone is really very, very good and is irreplaceable and has an extraordinary skill, the board is entitled to tell the shareholders that, to say, we've got this absolutely exceptional talent. It's in a part of the market where salaries and remuneration generally have been very, very high. We've had to compete with other companies in this talent pool. And so it reinforces my point of bringing some degree of rationality to incomes. We've seen so many examples that the media has commented on where companies have performed poorly, but CEO remuneration has performed exceptionally well. And in those kind of examples where there is no correlation between the value that an individual brings to a firm and the remuneration that that individual takes from the firm, the board will put the spotlight on it. It won't prescribe what should happen, but it empowers the shareholders to make that decision. When the shareholders decline to approve a report, then that remuneration report is not capable of being implemented. So that is quite an important and significant discipline that would apply on earnings. Then, does this incentivize employment outside South Africa? Well, of course, at the end of the day, when individuals make their decisions, there are people who may get a better deal globally. But in many jurisdictions, companies already provide a significant amount of information on earnings of top executives. So we would hope that we've been able to craft this sufficiently carefully by not prescribing, by not putting a cap on the incomes, that we're able to obtain talented people who will work in South Africa, and at the same time that we address public concerns by ensuring that there's transparency, that shareholders know what the income gap is between the executives and the employees. So the key has been to try to strike that careful balance. And it's not the only area in the bill that we've had to think very carefully about striking that balance, but it's one of the significant areas. And I would be most keen to get feedback from Parliament as the Portfolio Committee work through the bill on whether you believe that we've struck that right balance. There will be potentially stakeholders that would want much more to be done. Honorable members would have seen in public commentary, many stakeholders have asked for much more intrusive legislation. There are stakeholders that would want less to be done. Some of them may want nothing to be done on this matter. And some of those views have also been put in the public domain. But the role of the executive is in balancing all of that, is to put forward a package to Parliament for Parliament's consideration that we think properly and adequately addresses the concerns of citizens. This is vital in a democracy, that law must respond to concerns of citizens, and at the same time that it does so in a way that does not undermine our other objectives to grow the economy, to ensure that we attract top talent, and that our businesses can thrive domestically and globally. Honorable Mulder raises the question of the pay gap. I did take notice of a moment of high discrimination where Honorable McPherson was titled as comrade, and Honorable Mulder was not. I did not see Honorable Mulder complaining, but in case he wants to, I have opened up the door, I hope. But more seriously, on the matter of the pay gap between the top 5% and the bottom 5%. So the challenge we face is that if companies are only evaluated by the pay gap between the top executive, typically the CEO, and the lowest paid worker in a company, it may not give a good reflection of the general pay gap in that company. Because you may have a company in a particularly complex moment of its history that has to get an extraordinary CEO to navigate its affairs, and that may come with a very high bill. So you could have what is called an outlier effect, that this is one CEO in a company where the top management is not paid a lot more than normal, or in fact, they may be on the normal curve, but one person is paid a lot more for very exceptional reasons. And so if you only take the top individual and the bottom individual, it may exaggerate the pay gap. And so taking the top 5% of the income bands and the bottom 5% will help to give a more measured sense of whether a company in general is out of line in ensuring a fair and a reasonable ratio, or whether it is within that range. Honorable Tring, thank you very much also for your comments. We have taken note of the challenges that came up in the FATF process. I am pleased, though, that the bulk of those, or all of the concerns that were directly raised have now been addressed in the amendments, and the amendments that came through in 2022. And so many of those that had originally been proposed by the department are now part of our law. On the issue of incomes in the public and in the private sector. First, on the public sector, the observation, Honorable Tring, that you've made on municipalities also applies sometimes to national entities. And it's an ongoing dialogue, and sometimes quite a challenging one, because sometimes in the public sector, the argument would be made by managers that, or boards for that matter, that in order to attract managers of the requisite expertise, they compete for those skills with the private sector. So when private sector differentials are high, it imposes, they say, an obligation on a particular public entity to match that. We find that particularly in entities that are significantly exposed to the private sector, your regulators and so on, your development finance institutions and others, where the talent mix is often exactly the talent that the private sector is also looking for. So we hope that this wider disclosure can also help, and where these levels are out of kilt, that action can be taken. But it is striking just to see how many instances there are where public entity salaries are above that of the President of the Republic. And obviously running a country is quite a significant responsibility. And so I take note and agree with your observation there, Honorable Tring. On the private sector, the issue of Steinhoff is instructive, and so is the issue of Tongaat Hulett. I was in KwaZulu-Natal yesterday attending a meeting, among others, of the sugar industry to discuss the state of the industry and the measures that can be taken to strengthen the industry. And through the Sugar Master Plan, we were able to make considerable progress in the sector until we were hit by the problem with Tongaat Hulett. And Tongaat Hulett is an important company in the sugar industry. It refines almost half of South Africa's sugar, and it was forced to go into business rescue last year, essentially because of fraud in its accounting system, fraud by members of the board or executives of the company. That matter is now in court, so I'm not going to comment on the specific merits of it. But the effect of that was that a once proud and large South African company was almost brought to its knees, and it's still not completely out of the woods. And it shows why corporate governance is so important, and why we've got to constantly look at the lessons from all of these and see what reforms it may require. On the delinquent directors, Honorable Tring again made a very good point there. And it was a point that I think was inherent also in Honorable Macpherson's remarks, that it's all about trying to strike that balance in dealing with this. That we can't not deal with it. We have to deal with it, but we can deal with it smartly in a way that takes the public objectives forward. Honorable Malametsha brought an interesting additional dimension to it, which is how do we, if I can paraphrase what he said, what he was really saying, as I understood it, is given the particular history of South Africa and the high levels of unemployment, what does that mean for the debate and discussion on income inequality? Now, while the matter of executive pay does not directly relate to what a company may do in terms of employment, it does often often feeds unhappiness on the shop floor. So often trade union leaders report that they struggle to get a mandate from their members for a settlement of a wage dispute, even when they are able to point to the company's underlying financial performance, because employees would point to the outliers, the high salaries of one or two or small number of executives in a company. And so part of our generation's job has been to take forward the building of a united South Africa, one that brings together black and white South Africans with different histories. And that cohesion, that social cohesion, is very important. It's a very significant objective that we all hold dear, and which the Constitution provides a framework within which we seek to achieve greater and greater levels of social cohesion. And so I would say that it does make it more stark in South Africa than would be the case in many other countries. particularly given not only the history, but also the current impact of that history, that we remain a very, very unequal society on so many different metrics. And that means in South Africa, even if another country could ignore dealing with the issue of income inequality, in South Africa, it is an important issue for us to deal with. Honorable Malametsha then asks, does the Act set out how one determines the reasonableness of the remuneration? And the answer is no. The Act does not give a set of factors that boards must consider in determining the reasonableness of remuneration. There were proposals like that I have heard. But when we considered it carefully, and when it was debated in NEDLAC between the business community and the trade unions, everybody was in agreement ultimately that the significant reform that we're seeking to do with the company's law in this phase is greater levels of disclosure rather than the prescription of the criteria that should apply to the test of reasonableness. So we've left the issue of reasonableness to shareholders. For public companies, it can be compared. For private companies, it would be a matter, a large private company. The shareholders would have to make that judgment call, but they will have reference to what is happening in the market. There's a fairly active industry that tracks incomes in South Africa, with large consultancy companies normally managing that. I come across that from time to time when we have to appoint senior executives in state-owned companies. Then typically a board would bring to my attention a remuneration report that has been compiled that says for that particular expertise, this is the market rate, and it's typically significantly higher than what we can or should be paying in the state. So I think shareholders will have a lot of tools available to compare like for like, to say this company is in the mining sector, it is in this particular kind of mining. Yeah, the job of the CEO is a lot more complex because it is one where it's not just a significant management of a going operation, but it may be a mine that went through a difficult period. Whatever the circumstance of that company, they will be able to say, we take note of that. We're the shareholders in this company. At the same time, we now look at what other similar companies are paying. And board members, you've overpaid here. That is really what we've left it to, that the reasonableness will be on a case-by-case basis, conducted by the shareholders, looking at the information that the Act now requires be made available to the shareholders. The question then that Honorable Malametsha follows up with is, why are some companies excluded and what type of companies are excluded? In our approach in the Companies Act, this is the existing Act already, we make a distinction between what I can loosely call companies that are publicly significant or from a public interest point of view significant, and companies that, while they are very important as economic agents, may have a lower level of public interest significance. And where a company has a greater level of public interest significance, the requirements for disclosure and even conduct on such a company can be higher than ones that would apply to medium-sized businesses whose overall impact in the society or in the economy is less, shall I say, has a lower public interest expectation. What are the criteria that would apply? It would be things like the level of employment in a company. If you have a company of a smaller number of employees, there may be less societal consequence on that company through its wage policies, so its remuneration policies, than a very large company that has, more than 30, 40,000 employees. So that's one criteria. The other criteria is something like the turnover of the company, the economic output of the company. Obviously, it's self-evident the importance of a factor like that, or the significance of the company as measured in other ways that the Act and the regulations set out. So that's already covered, and we're not in this set of amendments proposing a change to that. There's already a public interest score in the Act. This was done in the major reform that came from 2004 to 2008. And we're really just putting this proposal within that framework. If I turn then to Honorable Monakedi, Honorable Monakedi also pointed to the some similar questions, but I'm going to pull out the ones that I've not yet addressed. And Honorable Monakedi's question, it was a very interesting question around the consequence for failure to obtain approval of the remuneration report. Well, there's two things that flow from it. The one thing is when a remuneration report is rejected, the bill proposes that the members of the remuneration committee should not be eligible to stand as or to be members of that committee for a set period. In the corporate world, if you have a mark against your name that you were excluded by operation of the law from serving on a remuneration committee for a set period, it affects your reputation. So we believe that that is one important way in which remuneration committee members will ensure that they apply themselves diligently to their responsibility, which is to manage the affairs of the company as regards payment for the senior executives in a manner that is consistent with the economic need of the company and societal expectations as would be expressed by shareholders in a company. But also the remuneration report itself has to come back to a future meeting, and the board would have to engage with shareholders in between meetings to ensure that those views are properly taken into account. Honorable Monakedi then asks the million-dollar question, which is, how will the bill ultimately address, what will be the impact on income gaps and inequality? And as I've indicated, Honorable Monakedi, we've taken the view, having considered it carefully, that what could be helpful in the South African context is a model that requires disclosure, that gives clear powers to the shareholders, that hold the board accountable, that requires both a remuneration report and an implementation report, so that there's a visibility and that all of these have to be, that the remuneration report has to be brought to an annual general meeting for the shareholders to look at. Could we have gone further? The answer is clearly yes, we could have gone further, but we do recognize that we need to be able to move with a degree of care in what is put on the table, that when the business environment is strong, robust, forward-looking, then Parliament may have one set of options to put on the table. When we're trying to build a greater level of business confidence and we're trying to strengthen investment in the country, we've got to find a careful balance between that imperative, that requirement, and the needs for us to respond to the the concerns of citizens and society. And we believe the balance that's been struck in the bill does that while it may be uncomfortable for a particular executive who is paid a very high salary, unrelated to performance, unrelated to challenges with acquiring scarce skills or high-performing talent, if that person is so embarrassed, if that board is placed under pressure by shareholders, that is as it should be. On the other hand, where a high-performance individual in an absolutely critical skill does earn more than their peers, and it can be defended by the board, then the board should so put out its case. It's that attempt that we're seeking to do here, and it follows considerable discussion between key stakeholders, with the business community through NEDLAC, with the Labour constituency in NEDLAC, and there will be some voices in business, not all, that would typically may not have wanted any regulation on this. There are some voices in Labour, typically not all, that may have wanted an absolutely tight prescription. And we try to find something that can, where we can build a broad consensus, but still have it as meaningful in society. Honourable Chairperson then raises the question on state-owned companies. Are salaries set by National Treasury, or does each state-owned entity set its own remuneration? Typically, for certain kinds of public entities, National Treasury would set the guidelines for board fees that board members get. In respect of CEOs, because there is such a vast difference between the skill level that's required, say, of an ESCOM, compared to, say, a small statutory body that may be responsible for accreditation of entities like SANAS, as an example. The skills levels of the CEO of ESCOM is not comparable to the skills levels required in SANAS. SANAS also requires strong skills, no question about it, but the risks of getting it wrong in ESCOM, as we have seen, is so enormous on the economy, on society, on citizens, that the level of the kind of person you look for in your top leadership is different. So there's been a lot of discussion in the state whether we should have a one-size-fits-all, or whether we have, in fact, guidelines that could apply. At the moment, Cabinet wants to have visibility on the payment of people who are recommended for appointment. And so there are from time to time pushback by members of the executive to boards on these matters. But as I say, the challenge is the very skills you need to run a successful public entity is often the skills that you need to run successful private sector businesses. And the state also needs to find people in that same pool, which is exactly the challenge. It's the challenge that Honourable Macpherson and Honourable Mulder had pointed to, which is the skills pool. And so there are no easy answers with these things. And so we've tried to find an approach that takes all of this into account. On consequence management, I've covered that matter, Honourable Chairperson, as well as how to determine reasonableness. So let me give back to the Chair. I hope I have covered all of the questions that came up in the comments by members of the Portfolio Committee.
Thank you very much, Minister. My apologies for stepping out of the meeting earlier. I think you've covered all the questions. We still going to follow a long road to get to the end of, or to get to the ultimate goal of passing this amendment bill. Can I just take this opportunity to thank the Minister for the very broad and thorough background that you've given to us for this legislation, and also to the members of the Portfolio Committee for their valuable input. Can I just ask the committee secretary to just broadly sketch for us the way forward as we consider the company's amendment bill?
Thank you, Chairperson. Just with regard to the process going forward on these amendment bills that were ATC'd and tabled and referred to the committee, we are in the process of finalizing applications for publication of these two bills and adverts calling for public comments. Ones that will probably happen within this week, and also we'll indicate on these adverts when the due date is, and the committee will probably most likely schedule public hearings in October, because we want to give sufficient time for the public to prepare comments on the bill, so that we don't have any challenges going forward when we have completed our process. So the intention is to publish these two bills for public comment, and hopefully during October we will schedule public hearings on these two bills as part of the legislative process and guided by the rules of Parliament in that regard, Chair. That is just a broad outline for the process as requested by you, Chair. Thanks.
Thank you very much. And I'm sure the committee will also get a document that lays out the roadmap for this legislation to pass through the committee.
No, definitely, Chair.
Okay. Thank you very much. That concludes our business for today. Thank you very much, members, and apologies for the connectivity problems experienced. Thank you.
Thank you, Chair.
Thank you, Chairperson.
Thank you, Chairperson.
Thank you, Chair. Bye, colleagues.
Recording stopped.